This is KTN Prime. Now, the interest rate cap was repealed in 2019 after being in effect from the year 2016 from commercial banks to the International Monetary Fund. Many had expressed the need to remove the cap over the last 3 years. The removal, however, has Kenyans wondering if banks will return to charging astronomical interest rates in the near future. KTN's Malika Kazi now takes a look at the journey of the interest rate cap in the country.
The year was 2016. Members of Parliament passed the law imposing a cap on commercial lending rates. Under the interest rate cap regime, banks were restricted from charging no more than 4 percentage points above the central bank benchmark. Section 36(4) of the Central Bank of Kenya Act stipulates that the central bank shall publish the lowest rate of interest it charges on loans to banks, and that rate shall be known as the Central Bank Rate (CBR). The level of the CBR is reviewed and announced by the Monetary Policy Committee at least every 2 months. For close to 15 months up to November 2019, the central bank rate had been maintained at 9%, meaning banks could charge up to a maximum of 13%, while the rate cap was in effect. The initial aim? To cushion Kenyans against prohibitive cost of loans. Before the law was put in place, banks increased their base lending rates to levels as high as 24 to 30%. However, over the 3-year period, banks continued to report profits, and experts partly attributed the growing credit crunch in the private sector to SMEs being locked out of access to loans, with banks choosing to lend to the government and larger corporations, limiting the risk factor.
The micro, small and medium enterprises are without doubt the lifeblood of our economy. This sector accounts for more than 80% of all businesses in Kenya and creates around 75% of all our jobs.
Over the 3-year period, bank lending to SMEs and companies reclined by 1.9 trillion shillings. For some time, commercial banks had been pushing to have the law repealed and won the support of local and international institutions, including the International Monetary Fund. The IMF maintained that the rate had the opposite effect of what was intended. During the national budget reading, then Treasury CS Henry Rotich led the government's push for the repeal of the rate cap and for 3 successive budgets sought to repeal the cap through the Finance Act. In October this year, President Uhuru Kenyatta sent a memo to Parliament detailing the reasons why the interest rate cap should be repealed. While rejecting the finance bill, he called for the repeal of Section 33B of the Banking Act. This would prove to be the final nail in the coffin for the cap, with members of Parliament abstaining from voting for or against the finance bill.
Electronic, as has been displayed, total present 136. Manual present 25. Total 161. The net effect on the motion is that the ayes have it and the motion is carried because we were not able to raise the 233 to take a vote, a vote either way. So the ayes have it, motion is carried.
With the cap repealed, banks were quick to reassure Kenyans that there would be no return to high interest rates.
I think the biggest challenge that arose during the capping era was the fact that a number of SMEs could then not be priced within the cap. So you appraise a product, or rather you appraise an account, and if the price, for example, for argument's sake, comes to say 15%, the law then was such that you could not extend credit to that customer at 15%.
It's true that with the interest rate cap, we saw a reduction in lending to the industry for micro and small enterprises. But if you look at the total lending portfolio, we're lending nearly 220 to 300 billion every year to this segment.
The Central Bank of Kenya has cut its base lending rate to 8.5% from 9% as of November 2019, marking the first adjustment to the central bank rate in 15 months. Well, 2019 has seen the repeal of the interest rate cap in Kenya, but even now, many Kenyans are still on the fence, waiting to see whether or not this will lead to greater access to affordable credit in the medium term, or perhaps a soaring of interest rates from banks that go back to the levels they were at before 2016. Malika Khan